Hello and welcome. Thanks for tuning in to All About Your Company today. Today we're going to be talking about Patel Engineering. Why is this interesting? One is it's in the infra space, and what we've seen with regard to infra is you're starting to see commodity prices have moved higher. Trying to understand therefore the impact on infra players and how typically agreements are structured and how long will it take to pass through. We'll try and understand that piece. But secondly, it trades at a single-digit P. It has its own set of problems. There's been very low to no growth that we've seen in a while now. What we're also seeing is the stock price has fallen 36% over the last 12 months. You've seen margin guidance being reduced to around 13% now, 13 to 14% or from 14 to 15 earlier. We're also seeing that order inflow, which was expected to be at around 10,000 crore, hasn't come through for this financial year. It's in fact only 3,000 crore as of now, 9-month FY26, and therefore it's very difficult to achieve that 10,000 crore number. Now, we'll also obviously understand whether there is some pickup with regard to orders that are coming through, and the Jal Jeevan mission. This is one of those plays because hydroelectric and the like, and my analyst Jainab was quick to point out that the Jal Jeevan mission is one of those which is critical to Patel Engineering. Now, let me take a step back. Let's try and give you a bit of a deep dive with regard to what the company is about. 1949 incorporated, so it has a very, very long history. It's promoted by the Patel family, operates in the infra EPC space. And we'll try and elaborate a little bit on that. The core of it is complex hydro projects, tunneling, irrigation, and civil infra is what it typically specializes in. And it has a market cap of around 2,900 odd crore. Now, in terms of the product or the service pipeline, in itself, it is largely an EPC company. It does civil hydropower, pump storage. I'll quickly take you through what civil hydropower is. Building dams, tunnels, powerhouses for hydroelectric stations. Pump storage is reservoirs, tunnels for pump storage plants. Irrigation builds dams, canals, lift systems, and farm water. Water tunnels, it drills underground tunnels carrying drinking as well as industrial water. Roads, bridges, which is construction of mountain highways, strategic border roads, and the like. There's road and metro tunnel as well that it does. It does mining excavation, removing soil rock to expose coal seams. You're looking at Boot Hydropower. This is one project which they've taken up where they own, build, operate hydroelectric power projects, and then they sell electricity long term. We will talk a little bit about that as well. And then there's legacy real estate. They sit on a large land bank of nearly 800 to 1,000 crore. So in that sense, also there is value unlocking which could come at play here, but we'll have to see how all of those moving parts play out. Now let me talk about geography and customers. 63% of their customer cohort is central government, 33 odd percent is state government, so 96% government tilt, and 4% is international, which is again Nepal and a hydro project there. In terms of the largest states, they have J&K, Maharashtra, Madhya Pradesh, and Arunachal as 4 of their largest states. The business model is fairly simple. They win orders through competitive bids and tenders. They sign EPC contracts at fixed margins. They execute thereafter, and revenue is recognized on a percentage of completion method. Build, own, operate, transfer. That was one of the businesses that they do. This is with regard to the Gungri Hydro project. 4 years is the construction period for it. The first year annual revenue expected from that project is going to be 300 crore. It is an EPC project and with a linkage to power, and they have a power purchase agreement in place for that. In terms of the cost structure, and this will be interesting to note because as material prices go up, this is an important piece. Construction comprises 73% of the cost structure. Construction plus employees is around 81% because employees is 8%. Then there's other expenses, which is roughly 6 odd percent. And last is finance cost, which is around 6%. So when you're adding up 73, 8, and 6, it's amounting to roughly 87. This is the actual FY25 cost structure, which kind of brings your EBITDA margin to roughly 13%. So that's the broad brush. Even within construction, it's important to understand that nearly 20% of that is materials. So you'll have around 20% of the cost structure tilted to materials. The balance is other construction costs, then there's employees, and there's other expenses. Broadly, that's the split. And that gives you kind of the weightage that materials has within this entire cost structure. Now I'll take a step back. Let's look at the financials of the last 3 to 4 years, try and analyze those. When you're looking at the revenue, it's grown at a very healthy clip of 23% on a YOY basis. So you've seen revenue go up. What you've seen also is margins, or rather EBITDA. EBITDA has done well for itself. It's up around 19% on a YOY basis. Profitability, though, hasn't played out as well as one would have anticipated, and that's because you've got a higher interest income, which has continued to weigh down on the total cost structure, and depreciation costs have gone up. So those are the two reasons why you're seeing a weigh down with regard to profit before tax and after tax. Especially in the base year of FY22, the interest expense was 420 crore versus the 300 crore number currently, and therefore that 100 crore delta is the interest expense, which is why you're seeing the very sharp surge with regard to profitability of a very, very low base of FY22, because that 400 crore rupee of interest burden on an EBITDA of approximately 500 rupees was where the challenge lay at that point of time, and thereafter came the taxes and depreciation. Now let me look at the 9-month figures before I go across and look at the margins. And in the 9-month figures, you're not seeing very strong revenue growth, just about single digit. EBITDA has actually come off. Margins have come down as well, and the margin guidance has been played down. And net profit is up just about 8% as a result. Now, the other piece is the 9-month, after the 9-month numbers is the EBITDA margins. And that is also interesting to understand. When you're seeing that margins were largely between 14.5% and 15.5%, there's been a sharp downtick when you're looking at the 9-month FY26 figures. It slipped below the 13% band. And that's where the street is concerned. But of course, they've lowered their guidance as well, and they're expecting possibly a pickup in growth in FY27. Margins largely to remain very, very range bound. The pickup in growth should probably add to profitability. And let's look at the balance sheet, because that's the other piece you want to understand along with this. What you're seeing is a book value of around 3,933 crore on 2,850 crore market cap. So this is actually trading at sub 1-time book. When you're looking at the borrowing number, that's where the concern really lies. The borrowing is actually quite elevated. I'll read out the number to you. The total borrowing currently stands at 1,540 crore at the end of H1 FY26, after which they've done a 350 crore odd fund raise. That fund raise should have taken care or should have reduced the borrowing a little bit. So that's the other thing we look out for as to how much has the borrowing number come down by as a result of the equity fundraise they've done. Also, they have a decent cash and bank balance of around 610 crore. So on a net basis, the borrowing doesn't look too bad, but at the same time, it's definitely weighing on the financials, because you've got that very elevated interest cost, and that to EBITDA is quite elevated, and therefore that is something that you want to continue to monitor even going forward. Let's look at cash flow now. In terms of cash flow, the conversion has been clean. In terms of cash flow conversion, you'll see 100% plus, except in FY25, where there's been a build-up both in terms of inventory as well as receivables. Receivables actually jumped 200 crore in FY25. As a result of that, you're seeing a way down with regard to cash flow from operations to EBITDA, and that has fallen to 50% as a result. There's been a bit of an unwind in this year. It's visible because the cash flow has gone up in H1 itself by nearly 200 crore. So you've seen a bit of an unwind of that clearly in H1 FY26. Now, let me talk a little bit about return ratios. And just on cash flow for a minute, they do around 150 crore of investment every year in terms of capex, and that's something also that you want to keep on your mind. So the rest of it flows through. So you're seeing a net cash flow of around 66 crore lying over there. In terms of return ratios, they've been below the 15% threshold. FY25 was 15%, but mind you, this is ROCE, and a large part of the capital employed is also debt, and debt servicing is at a very high rate. So at around 1,500 crore debt, they're doing around 300 crore of interest cost annually, which is quite elevated. We'll try and quiz management with regard to the interest rate at which they are funding that interest cost. But nonetheless, that is likely what is weighing down on the ROEs even more, because the ROE is far lower than the ROCE is what it seems, at least at this point. We'll quiz management on it. Let me now talk a little bit about shareholding. Shareholding has come off because of the consistent equity raises they've done. Every year from calendar year 22, they've done an equity raise, either through a QIP, either through a rights issue. That is to pare down on debt, and they've managed to do that. Also, around 85% of the promoter ownership, which is around 31%, is pledged, which is the other challenge. So all of that needs to kind of sort itself out, right? But a lot of these factors are reasons why valuations are super cheap. And let's pull up the valuation chart. What you're seeing currently is around a 6.5 times price to earnings. It does around 300 to 400 crore of PAT, 1 year forward, of course, and we'll do that math. Our 2-year average is around 9 times, and the 2-year range is around 5 times to 15 times in terms of price to earnings. In terms of guidance, they are guided for a 10% top line growth, 13 to 14% margin number, and near term net debt neutral is the goal. In terms of what this translates to in terms of valuations, around 5,700 crore of top line in FY27 at a 13% margin, which is the lower end of the margin, will mean around 750 crore of EBITDA. Around 240 crore of that will likely go in interest cost servicing, leaving around 500 crore on the table, 100 crore off on depreciation, which leaves 400 crore on PBT, which lands up at 300 crore PAT on a conservative basis. We'll try and understand, in fact, from the management as to how to read into some of these numbers and what to expect. Let me bring on board Ms. Kavita Shirvaikar, who is the Managing Director of Patel Engineering, joining us. Great having you, ma'am. Let me first start off by understanding, with regard to West Asia, you've seen elevated costs, both commodity as well as power. What does this do in terms of your margins, one, in the near term, and two, is how much of this is a pass-through, and how quickly are you able to pass this through?
Thank you, Harsh. Thank you for having me on the show. See,
Great having you,
now,
ma'am.
thank you. So our current order book is 15,000 crore. See, let me tell you, out of that, we have contracts from government, around 70% from center and around 30% from PSU, state government. All these contract covers escalation clause. There is a pass-through mechanism. So whatever price increase, there is a formula base where we can get paid from the client. So I would say impact would be minimal.
And on boot as well, you have a pass-through, because that is the other element. Is that under construction? What's the timeline of completion for that? When does the 300 crore starts to get recognized in your P&L?
So boat is in, we have recently signed MOU with the Arunachal government. It is 144 megawatt. So we are in the process of doing PPA and doing the financial closure for the same, which is in advanced stage. So we expect to start the construction in next financial year. So it will take 4 years for the construction, and thereafter revenue will start generating. It will recognize income of around 300 crores per annum.
But is there a pass-through on that as well, Kavita?
So I would say
a cost pass-through?
Yeah, see, I'll tell you it will be built. We will tie up the PPA cost plus mechanism. So in a way, it will be a pass-through.
Okay, so are you trying to say there will be no impact of this whatsoever on your margin guidance of 13 to 14%?
Yes, you are right, Harsh. Our margin would continue to remain around 13%, which we have given guidance.
And talk to us about order inflow and what traction you're seeing. The aspiration was to get to 8 to 10,000 crore in terms of incremental orders for FY26. That's not translated. Tell us, one, why, and second, is that likely to start translating in FY27? Is it just a delay, or there are other reasons why that is not translated?
See, our last year order inflow was, last financial year, it was around 4,500 crore. Yes, our target was 8,000 crore, against which it translated at 4,500 crore. See, I would divide into two parts. Order inflow is a matter of timing. When the government announces the project, when it comes for the bidding, and when we get LOA. Now, if you see current financial year, it's a good start for the year. We have we are L1 in 1,600 crore worth of project in Nepal. So for this year, our target is around 8,000, 10,000 crore. And April month itself, we are L1 in 1,600 crore project. See, let me tell you, with Indus water treaty suspension, large hydropower project getting clearance fast, around 5 gigawatt project, which includes Sawalkot, which includes Kamla, which includes Kalai, which got fast clearance from CEA and which is coming for bidding in near future. So this year, I think we are fairly confident we'll be able to achieve our target.
Okay, so you add up your order book, which is currently at 15,000 crore. You keep adding to that, in terms of what does Jal Jeevan Mission do in terms of the opportunity size available to you? You've got what is your bidding pipeline going to look like on Jal Jeevan Mission alone?
See, I would say ki we are mainly focusing in hydro irrigation, tunneling, and other infra-related works. Jal Jeevan Mission also around 16,000 crore outlays. Government has allocated the funds. There also we see a huge opportunity. So there, considering overall pipeline, considering all sectors, we have identified around 15,000 crore of order book, which we are going to bid in current financial year.
Okay, and you've seen some bit of competitive pressures as well, due to which you're likely to see some bit of margin compression. Are you seeing that on the Jal Jeevan Mission side as well? And are those competitive pressures reducing at all visibly versus Q3 FY26 when you gave that commentary?
So I would say the competitive pressure is continuing,
Okay,
considering that we have given the revised guideline of around 13%. So we have
okay.
already built that competitiveness and giving the guidance of around 13%.
And does that mean, therefore, that order inflow out of the 15,000 crore will be far lower than what you would have earlier or erstwhile estimated? Because
See, Harsh,
15,000 crore being the Jal Jeevan Mission opportunity. Sorry. Yeah.
so Harsh, see, I would say we already have a strong order book, 15,000 crore, which is giving us a visibility of next 3 years. See, we are consistent in our performance. So considering that we are not going aggressive because we would like to maintain and we would like to keep our balance sheet strong. We do not want to make the same mistake which other players and everybody made in the past. So we are mindful. That's why we are not running after the orders. We are whatever it is where we have a strategic advantage, where we can deliver fast. We have a strong team at the core of the company who are delivering complex infrastructure projects. So considering that, yeah, I would say there is a competitiveness, but because of we have a strategic advantage. See, hydro, where is the opportunity available? In Himachal, in Arunachal, in Nepal, in Bhutan. If you see, we have already placed, we are already there. That's why Nepal also, we got recently 1,600 crore of project which lower Arun. Arun 3, we are already working there. It is 35 kilometers from our existing site. So we have a strategic advantage. And current year, with the clearance of large hydropower projects, plus pump storage projects in pipeline, we see we would be easily meeting our target.
Okay. And Kavita, give us a sense. So you've targeted a 10% growth for FY27 on a near flat base of FY26. Give us a sense as to why growth isn't kickstarting for you, because you've obviously got a very strong order pipeline. What's keeping you from growing? Is it approvals? What's playing out?
So it's Harsh, it's not approval. See, I would say 15,000 crore order book to bill ratio is three times. So 5,000 crore consistently from existing order book. And now this year our target is around 8 to 10,000 crore. Being in hydro 60%, it takes 6 to 12 months for the mobilization of the site. And the revenue starts coming in from the next year onwards. So considering that, we are giving the guidance of 10% in FY27 and thereafter it can be more.
Okay, but there is scope for upside on that number, right? Is that the right way to think of it?
Yeah, it is. It will be based on the order inflow in current year and timing of the same.
Understood. I want to understand two things. One is you've done an equity raise of nearly 400 crore. Have you used those funds to repay debt? What are you doing with it? You're now sitting on a cash balance of 610 crore at the end of H1 FY26. You were already sitting on that. What do you do with the cash? And third, you're sitting on land bank as well, monetizable assets of around 800 crore to 1,000 crore odd. When do those get monetized? Because those will be critical moving parts for or to see a little bit of a turnaround with regard to the balance sheet itself. So give us some perspective on that.
So Harsh, as you have seen, we are consistent in strengthening our balance sheet. Our debt has come down from 4,500 to 1,600. 1,600 to now, if you see with the right issue and other monetization, this year maybe ending 1,300, 1,200 to 1,300. So consistently debt is coming down. Now, as regards monetization also, every year we are keeping a target of around 150 to 200 crores. Last year also we achieved around 180 crores from the monetization. This year also our target is around 200 crores to realize from the monetization of non-core asset. So considering overall our interest cost, if you see, though we have giving guidance of 10% growth, we are saying our interest cost will remain the same.
Right. Okay. Okay, understood. And give us a sense, what's your cost of debt right now? Is it maybe 15% or?
No, our cost of debt is around 11%. You are saying
Okay.
our interest cost is 300 crores. Why it is 300 crores on 1,500 crore debt? Because it includes, see, we have to take mobilization and equipment advance from the client, which is also around 1,000 crore. So our cost of funding is around 100, around 11%.
Okay, and what do you do with the 600 crore of cash? You use it for working capital? Is that why you've parked it there?
So see, we have around 40 projects running across all locations. So we have some, at the month end, whatever collection we receive, which is going to, disperse in the next month. So that's
Right.
how each project has some cash flow to, for their expenses.
Okay.
It
And
is
with
working
regard,
capital.
correct. And with regard to arbitration, there is, of course, some arbitration which is on. Give us a sense as to when do the recoveries start to come through of that. Of course, there's an order as well passed, if I've understood it right.
So around 800 crores arbitration award, which is in our favor. We expect,
Correct.
that's why we give arbitration and other claim put together, we give a guidance of around 200 crores, 150 to 200 crores, which will realize each year and which will help us in reducing the debt.
Okay, and so therefore FY27, FY28, the debt should continue to go down by around 150 to 200 crore every year. Is that something which is reasonable to expect?
So I would say it may not go down equal proportion. It will go down. We say ki for new projects, we may have to take working capital loan temporarily. So it will balance the debt. More or less, we say 10-15%, whatever growth we'll be achieving, our interest cost will remain the same and our debt will remain the same.
So your interest cost will remain 300 crore annually. Is that what you're saying?
Yeah.
Okay. Okay. Thank you so much, Kavita, for coming in and speaking with us
Thank you.
and giving us that perspective. Viewers, I believe that that kind of sums it up in terms of how to think of this. You'll continue to not see 240 crore, which I had built in, but probably 300 crore in terms of interest cost continuing going forward. So you'll largely see a flattening of the top line or the bottom line, even though a 10% top line growth will be seen. Broadly, that's the way to think of this. Of course, you could probably rewind and look at the conversation again. Thank you so much for watching, though, all the time we have on this edition of the show.